Now, many people now are retiring. The baby boomers now are entering retired age. Many people are retiring voluntarily because of COVID and all the restrictions that go with that. Many people are retiring because they don't want to get the vaccine and they're being forced out of employment. And many people just being laid off. We see an epidemic of big corporations finding reasons to let go people who are 55 to 62 because they're paying, they have a pension, they have high salaries, high health insurance costs, and they're culling these people and purging them from the employment rolls. So what happens? I mean, when you get into that situation, either voluntarily or involuntarily, where you're retiring, you got some big decisions to make, life decisions to make, irrevocable decisions to make, and too many. The vast majority of people make these decisions without proper advice, and that could cost thousands and thousands and tens of thousands and even hundreds of thousands of dollars over the course of their retired life. Very, very important. And many people are forced to make these decisions relatively quick because they're being let go. It's not like they're thinking it through. I'm retiring next year. Let me look at all my options. The first thing is, do you have a pension? All right, if you're going to have to make decisions on how you take that pension now. Some companies offer you a lump sum. They're not going to pay you monthly. Hey, if you want, you could just take all the money now. And that could be hundreds of thousands of dollars. And then you work with your financial advisor and decide how to invest it and how to take income from it and whatnot. I will usually advise people that have that option to do it. Because now you have control over your money. You don't have to wait till the first of the month, every month, to see your pension check come in. And you could change the amount. You could change the way it's invested. You could have an asset to leave your children when you die. In these pensions, when you die, they stop. I mean, at least when your spouse dies, in most cases. So you have no estate. That pension is not an inheritance to your children. Whereas if you roll over the lump sum into an IRA account, if there's anything left, your children will inherit it. Now, there's times that I don't recommend the lump sum. If I feel that my client is not good with money, is a spendthrift and will blow it, has vices, has marital problems, then I won't recommend a lump sum. But most of the time, all things being equal, I recommend a lump sum. Because when you look at the monthly income, if you're going to get a survivor benefit means when you die, your spouse gets a certain percent of what you were getting. Right? In that situation, and that's a tough decision to make. How much? And I'm going to talk about how to maximize that. But when you have a survivor benefit or a life pension or whatever it is, again, it's not an estate for your kids. But the thing is, you control it. You control how the money comes out. It goes into an IRA account, and you have total control over it. I don't want $1,200 a month that they wanted to give me the rest of my life. And then if I die, my wife gets $600. I don't want that. I want to be able to determine that if inflation hits, I could bring it up to $1,400 a month. It works out so good for most people. And if you do the calculation, how much are they going to give me versus my lump sum and what I can earn on the money? Can I do it myself and still have a big chunk of money behind me? They give you about 7% on average, depending on the option you take. If you take a spousal benefit, it's going to drop a little bit less. You could basically do that yourself. Yeah, you could take that money, invest it, diversify it, and take 7% a year and probably not even go into the principal much. And be left with a big chunk of money at the end of your life and your spouse's. Also, most people, when they look at, these are your options when you're not taking a lump sum. Life only pension, life only annuity. That's the highest amount you'll ever get per month in any option you have. But the problem with that is as soon as you die, it's over. And it doesn't matter how long you live. You can live 2 months and die, and that's it. Imagine that you had an option to take a $500,000 lump sum pension. Instead, you took the $1,400 a month, and after 2 months you died. and that's it. Nobody gets anything. It's kind of like Social Security right now, right? You don't have a choice to take a lump sum. But if you die before you even get to 62 or 67, whatever it is that you're going to take it, you don't get anything. But why would you want to set yourself up for that situation? Now, if you take a little less money, you could have your spouse get 50%. Now, there's different percentages they give you as options, but the more your spouse is going to get once you die, the less you're going to get at the beginning. You could have 100% my spouse gets. You're going to get the least amount of money of all the options they give you. So it's a game. Do I give up $400 a month so my wife will get exactly what I'm getting for the rest of her life? Most people choose the 50% option. All right, I'm getting $1,400 a month for as long as I live, but as soon as I die, it drops to $700. Well, that wouldn't happen if you took the lump sum and invested it. Your spouse doesn't take a 50% decline in income. Now, one of the things you could do, and this is what we do a lot, it's called pension optimization. And this is why it's so important to meet with a certified financial planner before you make these decisions. And I meet with people all the time that come to me, Lou, I'm going through retirement. I need your advice. I want to hire you as my financial advisor going forward, but I want you to tell me what option I should take here and what my options are. I mean, what are the ramifications, pro and con? And here's one of the things I do suggest, if the person's young enough and healthy enough, is to get a life insurance policy and take the higher amount. Take the life-only annuity. Because let's say it's $400 more a month. And you can go out and buy a life insurance policy for $2,000 a year for $500,000. Well, geez, you'd be ahead of the game, right? $400 a month, that's $4,800 a year, and it's costing you $2,000 for the insurance. You're $3,800 a year ahead. And if you die, your spouse won't be adversely affected because the life insurance will come in, and that will be used to fund her retirement. You see how that works? Pretty nifty. So you get a 20-year level term policy, which for 20 years you should be covered. After that, all bets are off. And you could get the higher amount each month. And I'm not saying it's going to cost $2,000 a year for $500,000. A lot of it depends on your health, your smoking, all that kind of stuff. I'm just pulling that number out of my head, but it'd be something between $1,500 and $2,000. We do it all the time, and it's very effective planning. Another question you have is my 401k plan. What do I do with that? It's amazing how many people just leave it there, which is silly. It's really a stupid thing. Why do you want your retirement tied up with your past company and all its other employees and stuff? Why not roll it over to your own IRA and have total control over it? Now, there's one time I would not do that. Is if you are under 59 and a half, but you're over 55, and you're going to need money out of that account to live on before you're 59 and a half. Typically, you take money out of an IRA account before you're 59 and a half, there's a 10% penalty in addition to the income tax on it. So if you're laid off and you're let go and you're unemployed and you're retiring and you're 56, you can't access that money in an IRA without all kinds of penalties, but you can do it in a 401k. There's a specific exemption in the law for 401ks that if you're retired and you're 55 or older, you can take it out without the 10% penalty. So if you're going to think you're going to do that, leave it in the 401k until you're 59 and a half and then roll it over to the IRA. Or leave some of it, the amount you think you're going to take out over the time between you retire and you're 59 and a half. Really good planning tool. But there's advantages to rolling it over to the IRA. You could work with a financial advisor then. They'll be managing the IRA for you, they'll be getting compensated on it, and you could work hand in hand with that financial advisor to make the portfolio your portfolio that works for your risk tolerances and your objectives and what you're trying to achieve. Number two, getting money out of an IRA is a lot easier than going through the hoops that you have to go through with a 401k administrator to access that money. Also, you have unlimited investment options. Typically a 401k will give you 10 options, 10 different places you can invest the money, all with one investment company. But once it goes into an IRA account, you have every investment available to you that trades on the stock market, any mutual fund, any stock, any bond, gold, silver, commodities, what have you. Definitely what you should do. And so many people have stranded or abandoned, I call them abandoned 401k plans. They work 3 or 4 places and they still have balances in each of those 401ks because they never investigated the options that they had. Why not consolidate them into one IRA account? Smart thing to do. Very smart thing to do. What else do we have for you today? Let's see. We went over inflation. I have so many things here on inflation. It's one of my big piles today. But I'm not going to touch on all of it because we did that in the first segment. I don't want to go too much overboard with that. Let's see. All right, let's go here. We know that housing prices have been going out of the reach for many people, and part of the reason for that is investors are buying huge percentages of existing homes. And when I say investors, this could be a group of 3 or 4 people. It could be large investors who have 100 or more properties and they're gobbling it up. It could be hedge funds. But many, many entities now are buying homes for investment. You can't get return anywhere. So these big hedge funds are saying, okay, let's buy up all these houses, even if we have to pay up for them above asking price, up the rent and rent them out. Because Americans can't afford to buy these houses because they're outpriced. So what we'll do is if we pay our mortgage, well, most of them don't have mortgages because they're using cash to buy these homes, and we rent them out for $1,500 a month to $2,000 a month, we're going to get an 8% return on our money, or even greater. And many of these big investors, BlackRock and other hedge funds, have been buying them. And you wonder why. You bid on a house, and before you know it, it's gone. You say, well, what happened to my bid? Oh, somebody bid $30,000 above you. And how can you compete with these deep pocket, entities? You can't. And that's not why we're seeing housing inflation the way it is. 1 in 4 homes are being sold to investors or group of investors right now. That's pretty amazing. And that's pricing. How it works this way. It's almost like kind of what was the guy's name on It's a Wonderful Life? Potter, right? Potter owned all the houses in Pottersville, right? And so he charged all the peons in the town there rent, and he had total control of the housing market. It's the same kind of thing. These big investors are basically gobbling up the United States housing market, and now since Americans can't afford to buy these inflated homes, they're forced to rent them, and that's putting people in serf land. They're becoming serfdoms. And that's where we're going. More and more people are renting now, and we're seeing the rents. That's one of the big things in the CPI. Rents are skyrocketing, and there's nothing you really can do about it because you can't buy the homes. And that's adding to the inflation, housing inflation as well. Now, when mortgage rates start going up, if they ever do go up, they're over 3% again, after being down around 2.5%. Mortgage rates are tied to the 10-year Treasury bond interest rate, which briefly touched 1.6% this past week. I think it's right now we're at about 1.5 something, but it wasn't long ago that was 1.2. So when you see interest rates going up in the 10-year Treasury, that means interest rates are going to be going up in mortgages. And if housing is unaffordable now, what's going to happen when mortgage rates are 4% or 5%? housing will be absolutely unaffordable for most Americans. And I think that's why the Fed is holding back on raising interest rates and stopping their quantitative easing, the printing of money, and all that, because they know that if they start battling inflation the way it's traditionally battled, which is rising interest rates, stop creating money, which they can't do because the Fed's not going to stop deficit spending and continuing to need the Fed to print money to buy it. But if they did, I mean, we're close to Jimmy Carter inflation if you calculate it properly. And they should be raising rates like crazy right now. But we're still at zero. It's not even like we're at 2%, which would be low. We're at zero. The Fed doesn't even believe they could raise interest rates a quarter of a point without disrupting markets. Think about that. Paul Volcker was raising rates 2% a meeting. The Fed meets every 6 weeks. They were raising it 2% every meeting. So over the course of a year, they went up to 18%. There's no way in Hades that the Fed could do that now. They can't even raise rates to 2 or 3% without cratering everything. The housing market, the stock market, the bond market, they can't do it. Not to mention the derivatives market. But if they did, everything comes to a halt. Everything crashes. The affordability of housing, which again is unaffordable for many Americans right now, would only get worse. So all the demand for housing all of a sudden was going to start to evaporate, or you'll only have investors buying homes. But you'll lose a big swath of demand for housing. What happens when demand goes down? Prices go down. And that's what they're looking at. They're between the Fed and other central banks around the world. The problems that we see here in the United States are worldwide. Debt, debt, debt. And central banks have all done the same thing. They've printed money. They've kept interest rates at zero or negative in some cases in Europe. And we're seeing rampant inflation worldwide, and central banks scared to do anything about it. So they have a devil's decision here to make. Do you crater the economy, the financial markets worldwide by battling inflation? Or do you do nothing and inflate the financial markets and let inflation run? And there's no in between. Because if they raised rates, just say they met their next meeting and they raised interest rates from 0 to 1%. You want to talk about a financial crash in the markets that day? Like nothing you've ever seen. That's how sensitive inflated assets are to interest rates. It's all the free money, all the cheap money that has inflated the stock market. You know, 35% of all dollars out in existence right now were created in the last year. 35%. It's an insane figure. That's inflation of the money supply. Now, I show clients and new clients that come to see me in my conference room, I have a chart of the M1 money supply. The Fed provides that. And I haven't updated it lately, which I have to do. But what it shows is, since 1970, a very gradual increase in the money supply, up to $4 trillion in the beginning of 2020. And then the chart goes straight up. I mean, like, way up. It goes to 18 trillion from 4 in 1 year. It's the scariest chart I've ever seen. It's a chart of hyperinflation. It's a hyperinflation of the money supply, which always happens before you have hyperinflation of consumer goods and services. Because once the money supply is inflated, that money starts chasing goods and services, bidding them up, including markets. You would think that, you know, in the beginning of 2020, would you ever have thought, giving the worst pandemic, the shutdown and lockdowns of economies worldwide, the cessation of shipping and bottlenecks and that, riots in the summer, political chaos with the election, 68 million people losing their jobs. A toilet paper shortage. Would you think that the stock market would have ran last year like it did? To record highs? I don't think anybody would. You would say, no, the market would crash. And initially it did. Until the Federal Reserve came to the rescue. And Congress and the President with the stimulus checks and the unemployment and all that stuff. And all that money that was printed and injected into the banking system and the economy found its way into financial markets in the form of inflation. As I said, the money supply inflated 400% in 1 year. From more than that, from 4 trillion to 18 trillion. Now, I don't know what it is now. I have to do my research on that. It's much higher because they haven't stopped. My guess is it's 20-something trillion. So that straight line up is continuing. Scary as all. To see this chart. When I show clients that, they look at me, their eyes get wide. Because they know what it means, at least to some degree. I explain to them what it means afterwards. It means hyperinflation in our future. And it's here. We're seeing it now. In everything. The next thing in inflation is empty shelves Joe. The trend line is there. The hashtag is there now. Empty shelves Joe. People around the country are experiencing it. And it's very unnerving. Like I said, thankfully I haven't seen much of it here. At least that I know about. But I know Costco is rationing toilet paper, paper towels, and cleaning supplies again. And a lot of that stuff, unfortunately, we don't manufacture a lot in America anymore. It's got to come from China and other places around the world. And now we can't unload those ships and get it distributed across the country. So empty shelves, if you don't see them now, they're coming. Stock up now while you can. Because there ultimately is going to be shortages of almost everything. And if you can get them, the question is at what price? But soon, it doesn't matter what the price is. You're not going to be able to get them. All right, top of the hour is 732-505-1160 is our call number. My name's Lou Scatigna. Don't go away.